Ladies and gentlemen, welcome back to the channel. Tesla stock had a great day today. Now we will go over what the news was in case you missed it, why Tesla stock outperformed the market so strongly today. It's news that you must understand it and internalize because it's going to be something that's with us for a while, okay? Beyond that, we will go over some other Tesla stock news that we did not cover in the last video, related partially to the news today that sent Tesla stock higher. We are going to look at the warning, if you will, from Tom Lee and what could be coming next in some of this seasonal weakness in markets, but the inevitable rally into the end of the year. And we will also discuss the economic data coming out tomorrow morning that is going to be the main driver for stocks. Ladies and gentlemen, things are about to get exciting on Wall Street and exciting for Tesla stock. In my opinion, we are in this technical breakout that I think could lead into a much larger rally for Tesla, sending us well into the 400s, potentially even 500s. By the end of this year. Hit that like button and subscribe to the channel if you have not done so already. Check out that link down below in the description of this video for the trading community if you have not done so already. What we're doing over there is investing and finding these small cap, hidden gem, if you will, AI stocks that are fantastic companies, great companies, better than a lot of the names that you have heard of, SoundHound, BBAI, CoreWeave, some of these other stocks, growing at faster rates, higher insider ownership, and bigger total addressable markets in a lot of the cases, but are trading at a third or a quarter of the valuation of some of these other stocks. Why? Because they're unknown. And I think some of these stocks are about to have explosive rallies into the end of the year. Again, not to toot the horn here, but we are outperforming 98% of hedge funds and institutions year to date. Performance is up about 71%. So Wall Street can't really hold a candle to this strategy again so far this year. And I think this outperformance is going to extend well into the end of the year, into next year, and probably for the next couple of years. The idea is we want to grow this portfolio to over $1 million by about mid-2027, so about 2 years or so, investing maybe $1,000, $2,000 a month into this portfolio along the way. Again, not a financial advisor. This is not a recommendation. The proof is here. The outperformance is here, but nothing is a guarantee. You could lose all of your money if you blindly invest your money in stocks that you do not understand. So read the disclaimers, always contact a financial advisor, but link is in the description of this video if you want to come join the journey. But with that said, let's get into today's episode. So let's briefly give an overview to why Tesla outperformed the markets so strongly today. And the markets didn't exactly do great today. Tesla was up over 2%. So here's the deal, okay? Tesla is talking about raising prices on the Model Y in the US because of the demand surge. Now, that would obviously be great for profitability. Wow, that would be fantastic. Okay. We don't know if that's going to happen. That's just speculation at this moment. But you are seeing record low inventory numbers for the Model Y. Now, betting markets like Kalshi are putting Tesla at delivering close to 500,000 vehicles for this quarter. Now, the estimates jumped a lot over this weekend upon the almost zero inventory for the Model Y in the US news, okay? Estimates went up like 60 to 80,000 pretty much across the board. We haven't heard a lot from major bank analysts yet and what their estimates are, but as they start to come out and these estimates are going to be close to 500,000 if not higher, I'm sure that's something that's going to continue to positively affect Tesla, especially since the IRS has kind of extended the tax credit, if you will. You only have to put in a purchase order by September 30th to actually qualify for the credit. So this could extend demand into even Q4, right? Because if you place your order on September 29th and put a $100 deposit down, Tesla's not actually recognizing that as a delivery in Q3 if your vehicle is delivered in October or November, right? Because we're looking at like a month or two for a wait to get a Tesla right now. So that delivery would actually be recognized in Q4 with organically strong delivery that tends to happen in Q4. You could have a very strong Q3 and Q4, and I think that is yet to be fully priced into Tesla stock, and this could lead to an even larger rally. Now, consider that we're going to get interest rate cuts heading into 2026. The hopefully economy just continues to get better. The big beautiful bill, there's a lot of positive provisions in that. We're not going to go over all of that here in this video. We've talked about it probably 50 times on this channel. You should be well aware of how the big beautiful bill, if we can call it that, is positive to economic growth from a tax perspective, deficit perspective, all of that. So you could see a strong Q3, Q4 that leads into a strong Q1, Q2, Q3, Q4 of 2026. And that is certainly not priced into Tesla stock at this moment. And that's why Tesla had the strong outperformance today. Now, as we get more news, again, more firms that start to raise delivery expectations, that's going to be important because that's what really Wall Street buys Tesla on, okay? Whether Tesla's going to have a strong or weak quarter. Like, Wall Street is not looking at the AI prospects of Tesla. And I do think into the end of this year, what's really going to fuel the strong rally for Tesla and into 2026 is not strong deliveries, even though I think there's upside to delivery numbers. And that could definitely help Tesla stock. It's not going to hurt Tesla to have good deliveries, but the alpha here, the double in Tesla, the triple in Tesla in the next 12 months, I think is really going to come from robotaxi expansions and AI revenues, okay? For an example, if Tesla could just get 10% of their revenue to be AI related, like robotaxi, I mean, that could double Tesla's profitability. Just a 10% AI, revenue, right? A little bit goes a long way when it comes to AI. And you're not pricing in anything positive from AI at this moment. Yes, the multiple is high. Yes, there is some kind of, credibility placed on Tesla being somewhat successful in AI into the future. But nobody's buying Tesla today from a hedge fund institutional perspective, expecting anything positive in the near term from AI. I think we could start to see some positive developments. I mean, we already have, but I think we're going to get a lot more in terms of expansions to the Austin network, opening that up to the public, getting, as Elon said recently, hundreds of Model Ys into the San Francisco Bay Area in the coming months and expanding further into different states and cities into the end of this year and next year. That to me just seems like an upside surprise after upside surprise that is waiting to occur. And that's partially why I think we could see a bit of a short squeeze mixed with a gamma squeeze because people are so negatively positioned. And from a sentiment perspective, people are negative on Tesla. And I think that this is the wrong time to be negative on Tesla, like hands down. But here in the news as well today that we should cover, Tesla's looking for delivery vehicle preps positions across the US. There are now about 64 open positions. The estimated delivery period for the Model Y L, which Tesla China is selling, has been extended to October from September previously. So not just in the US is Tesla seeing really strong demand, but in China, Tesla's seeing really strong demand as well for the Model Y L. So mixing this together, and yeah, you're going to see a strong Q3 and a strong Q4, which I don't think a strong Q4 is priced in at this moment. Most people are like, hey, Q3 sure is going to be strong. And that's why Tesla's moving up a little bit today. But wait till Wall Street realizes Q4 is going to be strong as well. And I think that just further rallies the stock. Now, since the launch of the new Model Y in the Korean market, Tesla Korea has sold more than 20,000 vehicles without offering a test drive. You could see a lot of new Model Ys on the Seoul road. This comes from Tesla Chan. Now, I do want to get into what Ryan Dietrich and Tom Lee are saying about this market, about some of the seasonals, and share my perspective on this market going ahead for the next 6 weeks or so. Now, if you guys don't know who Ryan Dietrich is, he works at Carson Research. Carson Research and Ryan Dietrich have been right up there with like Tom Lee in terms of accurately predicting this market and giving out very useful information. Ryan Dietrich on X says Friday was a rare 90-90 day, meaning 90% of the volume and stocks on the NASDAQ or New York Stock Exchange were higher. These events tend to be quite bullish, with the S&P 500 higher more than 90% of the time a year later and up more than 23% on average. So yeah, it tends to lead to very positive returns following these events, which took place on Friday. Ryan Dietrich says 90-90 days were quite rare in the 80s and 90s, but we've clearly seen more of them since the global financial crisis. Bottom line, the action Friday was to be filed away as another reason we are still in a major bull market. Any weakness should be fairly contained and would be an opportunity. Now, this is some of the seasonal weakness that you could maybe expect to see between now and the end of September, okay, where stocks generally tend to move lower and end up falling close to about 2-3% in post-election years by the end of September. You could see the last little low here before you really kick things up a notch in October, a little bit of a slight drawdown early November, and then pretty much off to the races towards the end of the year. So as I've talked about before on this channel, I think from really mid-October through the end of the year is going to be really strong, and then I think 2026 is going to be really strong. My thesis for this has nothing to do with seasonality, okay? I think between now and, early October, we're still in the process, Wall Street is still in the process, I should say, of trying to figure out, are we going into a growth scare? How strong or how weak is the economy? And with each data set, it's going to bring new worries or new optimism, okay? And it's impossible to know from this perspective at this point in time what that data is going to look like later on throughout this week. So if that data disappoints, we could see some weakness. If the data comes in good, we're going to see strength. But I do think towards, mid-October, we're going to have a little bit better of an understanding that we really didn't get a growth scare. The economy's doing fine. At that point, you start to get into some seasonal strength in the consumer with consumer spending patterns. And I think the holiday season is going to be quite strong. And you start to get into that, more of the aggressive spending in about mid-October. Okay, people getting ready for Thanksgiving and Christmas and traveling a little bit more. And I think generally that's when the growth scare ends. Now, we've talked about this before on the channel, but everyone was back in May talking about a growth scare that was going to come in August and September. I mean, like, we're living through that right now, where Wall Street, I wouldn't say they're scared, but they're trying to figure out what's going on with the economy. Any bad data set is going to lead to more fear, especially with the seasonal weakness. And that's some of the risk that we have over the next 6 weeks. But I do think into the end of this year, it's going to become clear. The economy is doing fine. Inflation is on a downwards path. 2026 is going to be a good year. Inflation maybe even comes back to 2%. Obviously, we'll have to see. But trade wars hopefully are coming to an end by mid-October, towards the end of this year, okay? AI spending still fully intact, doing fine there. We'll hear more Wednesday with NVIDIA earnings. And then we have a, AI boom, right? Big, beautiful bill, 100% capital depreciation for CapEx, right? Capital expenditures. So for an example, if you're a farmer and you wanted to buy a tractor, you can now write off 100% of that in the same year you buy it, instead of previously you could only write off 40%. This could spur a lot more economic activity than most people think. No tax on tips, no tax on overtime. up to $25,000 for no tax and tips, up to $14,500 for no tax and overtime. That could also be substantial, along with some of the other smaller provisions like being able to write off interest on auto loans, things like that. Could really help boost this economy a little bit. Mix that with Wall Street's expecting 3 to 4 rate cuts this year. Okay. And I see the end of the year as a realization moment for most of Wall Street that, wow, the growth scare just didn't come. The economy's doing fine. Inflation's not a problem. AI is alive and well. And maybe the consumer and economy can do better next year. And really, as we get into the end of this year, the focus is going to be on 2026, right? Nobody's investing in stocks today based on, the next 2 or 3 months for the most part. People are more focused on next year, and people are just trying to figure out how are things going to be next year. And I think by the end of this year, we're going to have a really good understanding that things are going to be better than where Wall Street is currently seeing them. For September 17th, the odds of a rate cut at 82.9%. Again, it's going to be up to the data. If the jobs report comes in really strong, the economy comes in really strong, these odds are going to fall. But that's not necessarily bad news, right? If the labor market were to be negative, let's say, in the next jobs report, that's going to be really bad. Stocks are not going to react positively to that, even though the odds of rate cuts would skyrocket. So you almost want like a not super strong, economy, not super weak either, but you really just want to see inflation continue to come down, right? That's what you want, or not, skyrocketing further, okay? October 29th. You're at 47.9% chance of just one cut by October 29th, a 44% chance of 2 cuts. And for December 10th, you're at 46.9% chance of 2 cuts and 32.3% chance of 3 cuts. So again, depending on the economic data between now and then, it's really going to determine how many rate cuts we're going to get. And that's why each data set is going to be important, and it's going to move the probability for Fed cuts. But remember, interest rate cuts are not in and of themselves bullish or bearish. The reason why the Fed is cutting rates is what's bullish or bearish. Think back to 2020. The Fed cut rates to 0 overnight on a Sunday. Stocks crashed the next day. Okay? Massive rate cut. Stocks crashed. Why? Because that's saying, hey, the economy is about to go in the shitter, right? If we start getting really bad economic data, that's not going to be good for markets. Okay? In an ideal situation, you want to see the economy doing well, but inflation plummeting. That would be the best case scenario, but a more reasonable case scenario would be the economy holding up and inflation coming in lower than expected. Not necessarily plummeting, because we're still dealing with one-time price increases from tariffs. Difference between one-time price increase versus, long-lasting inflation, just to put that out there in case anyone was confused. There's a difference. I don't think long-lasting inflation is coming, but just one-time price increases are coming. And presumably the economy is not, crashing right now. Like, things are pretty steadfast, unchanged in my view. Tom Lee says this remains the most hated V-shaped rally. And what you can see here is Tom Lee is expecting, maybe some more strength in markets heading into around what would look to be like early to mid-September, and then to get another drawdown, okay, towards, end of September, around there, and then to get a larger rally. Now, Tom Lee, based on this, these arrows, would suggest like a pretty meaningful decline, right? It would suggest like a, getting back to like what on the S&P, like 600, which would be a huge decline, believe it or not. And then to power higher to 6,800 to 7,000, or 680 to 700 on the SPY. I don't think we're going to get anything like that. I think if we do get seasonal weakness, down to 620 on the SPY is about the extent of the fall that I could see from here. Like, something would really have to go wrong to get the markets to fall more than that. And from here, that would be like a 4% decline. Okay. We entered a new bull market once we broke prior highs. We're only like, what, 7%, 6% into a new bull market. Okay. And I do ultimately think we're going to hit 700 on the SPY by the end of this year, in my view. I just don't think we can go all the way down to 600 by late September, early October, and then go all the way back up to 700. So I kind of disagree with Tom Lee here. I think he's calling for a little bit more weakness than I am. But again, worth keeping in mind someone like Tom Lee and his opinions here. I just don't see the economy weakening that much to cause that much fear. Like, again, going from 645 or so, roughly where we are today, down to, let's say, 600 on the SPY, would be almost a 7% decline. Something would really have to go wrong to get that kind of a move lower, in my view. Let's get into your breaking news today in markets. Now, tomorrow is going to be an important, putting an important piece of the puzzle together, because today we got some regional data: Chicago Fed National Activity Index, new home sales, Dallas Fed Manufacturing Index, like nothing too crazy. But on Tuesday, tomorrow, you get durable goods orders month over month. Okay. You're expecting -4%. The expectation, or the actual number from last month, was -9.3%. So you're expecting a bad number, like month over month, to be -9.3% and then to be -4% is not a good number. Okay. If you were positive, for an example, 9.3% tomorrow for durable goods orders, you'd essentially be at 0% for the last 2 months. To be -4%, that's like really bad. Okay. That's like -13.3% for the last 2 months. When expectations are this negative, there's typically room for an upside surprise. Don't be shocked if we do get an upside surprise for durable goods orders. That's one of the stronger economic data points. Okay. Later on this week, on Friday specifically, well, on Thursday, I should say, we have the GDP growth rate quarter over quarter second estimate for Q2. The second and third estimates don't tend to move too much. So as long as we don't get a huge move, stocks are not really going to react too much to that. But on Friday, you get personal spending. You want to see this come in as high as possible. Okay, because if we are going to get the seasonal weakness, it's going to be from the economic data. It's going to be from a growth scare. We just smashed earnings for, Q2. Like, the expectation was 4% year-over-year EPS growth. We came in at over 11%. Like, earnings have been great, and I don't think there's a reason to be like super negative on NVIDIA earnings. Sure, could there be hedging? Could there be some profit taking or nervousness over the next 48 hours? Of course, but after NVIDIA earnings, I think there's going to be a strong reason, to be optimistic on AI, to be, revert back to the status quo, if you will. Who knows? If NVIDIA says something really good, then maybe that just further ignites AI. It's not my base case. Base case is NVIDIA gives us a beat and raise. Whether that's, good enough, blah, 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 you could argue about that if you want to. But if we get a seasonal correction, if you will, like Tom Lee's kind of forecasting, it's going to come from the economic data. I don't think we're going to get economic data that is that bad to give us like a 7% drawdown. So from my perspective, could you get some volatility here? Sure. Wall Street's just really trying to figure out, are we going into a larger growth scare or not? That's it. If we're not, the data is going to show us we're not. And we're not going to get that larger drawdown. Specifically for Tesla, Tesla is one of those stocks that is very high beta, okay? When it does well, it does very well. When it does bad, it does very bad. It's an AI name, one of the best in the world, if not the best in the world, in terms of real-world AI. That opportunity is not priced in Tesla. That is why we are all buying Tesla, okay? That is how you know the opportunity is so large in Tesla from the stock's perspective, because it's not priced in. You do not want to buy a stock where the good news is priced in, right? And with Tesla, you don't have that, okay? Which again is a positive. Tesla stock today is moving up on higher delivery expectations. I wouldn't be shocked if this continues. as more analyst notes come out that expect a strong Q3. We'll see if they start to pick up on what could be a strong Q4 as well. This could be a gift that keeps on giving. But the real upside comes later this year into 2026 when Tesla's AI efforts start to actually show that they are going to be the dominant one in the ride-hailing AI mobility service, right? That Tesla is a real AI company that is not priced in, and that is the true upside. Again, seasonal weakness period. It's going to come down to the economic data and what happens next for stocks in relation to that. I'm just not super nervous right now on the economy. I think if anything, it's kind of status quo. I don't really think the economy is like super strengthening right now. I don't think the economy is super crashing right now. And again, since May, everyone's been talking about this seasonal correction, this weakness that is going to come in August and September. And it's been pretty widely forecasted. And I think that's why a lot of people are bearish. Like when you look at the AI investor sentiment survey, you have like 45% of investors that are bearish over the next 6 months. People are bearish on this market. They are not positioned in this market the way that you would expect with stocks at all-time highs. And I think that is, again, an upside catalyst from here, not a downside catalyst. In markets, generally speaking, it's vice versa, right? If everyone's bullish, the risk is to the downside. If everyone is bearish, the risk is to the upside. While saying everyone is bearish is kind of a generalization, I would say everyone is bearish. Like, most of Wall Street institutions are bearish right now, or they're not super excited or bullish on markets. That is an opportunity. And that's going to be specifically an opportunity for Tesla as Wall Street really starts to focus on AI into the end of this year and 2026. So let me know your thoughts on all of this down below in the comment section. Are you a little nervous here? Do you think we're going through a seasonal corrective period ahead? Or are you steadfast in the mission? Hit that like button and subscribe to the channel if you have not done so already. Check out that link down below in the description of this video for the trading community. As always, read the disclaimers, contact financial advisor. Do not blindly invest your capital alongside anyone else. I share my trades. We go out, we're doing a lot of due diligence. We're finding those hidden gem AI stocks. Who knows? Some could be fraudulent. Some could be bad companies. Like, there could be things that we miss. You could lose money, okay? It's not the idea. That's not what I think will happen, but it is a possibility, just like everything else is. So, with that said, check it out. Link down below in the description of this video. You guys have a great rest of your day, and I will see you in the next one.